And we are live. Hello, everybody, and welcome back. We've got a great live stream for you guys today. I am here with Mitch Mechigian from Fifth Era. We're going to talk about investments, how to build and grow successful companies, and maybe even some of Mitch's predictions for 2026 if we get that far. Mitch, thank you so much for joining us today. How you doing? Are you all right?
Yeah, doing fine. Thank you for having me. Really excited to be on the show.
Thank you so much for taking your time to be here. I know you're a busy man. There's a lot has already happened in the first 21 days of 2026. So we're going to jump into that. Obviously, also tap into your experience as a seasoned investor in and around Web3, blockchain, and crypto technologies. Before we get started, guys, this is a LinkedIn Live. So if you have any questions for Mitch or for myself as we go through the show, please make sure to put them in the comments. We'll try to do our best to get to them live. Or if you put your comments in after the show, we'll try and jump back in the comments afterwards. So Mitch, for those people who don't know you, could you give us your brief introduction and how did you find your way into Web3?
Yeah, great. And before joining, I was just watching Trump's speech at Davos. So it certainly is interesting times and happy to comment on that. But obviously our sector is, in relation to the government, it's been critical what's happened in the US. But so, my undergraduate work was in mathematics. I graduated a degree in math, and then after that went to Wall Street to work at Morgan Stanley, both in London and New York. While I was at Morgan Stanley, got very interested in crypto personally. That was around 2016, 2017, specifically when Ethereum came to prominence. I just thought it was very interesting, smart contract platforms, everything that I thought it could open up. But ended up, instead of going directly into the industry after investment banking, doing a master's at the London School of Economics. And that was in international political economy. And it was a research-based master's. I still live in London, have for the last 8 years. And the title of my dissertation was Cryptocurrencies and State Capacity. So I was very interested at the political intersection with the economy, with governments, of blockchain networks, which I thought could threaten, government's core competencies. And so I think that's come to fruition, why the government obviously has been a very, integral part of the crypto industry, for better and for worse, as I'm sure a lot of your viewers know. And after that, I joined Fifth Era, which at the time was called Blockchain Coinvestors, which I'm happy to go into, but is essentially a specialist asset manager, venture capital firm. I joined very early on as we were launching our first fund, spinning out of the family office of Matthew Lamerle and Allison Davis, and have been a partner there the last 4 years, leading our direct investment business. And so we invest in all stages of companies, but specifically we invest directly under the cap table of companies as they hit more mature stages. So growth stage, late stage, things like that. Some big names of companies, people know in the sector: Kraken, Securitize, Uphold, Bitwise, names like this. So that's really the business that I lead. So yeah, have been now in, it feels like a very long time, but I guess 9 years, very closely involved in the sector. Came from academia, but now very much sit on the investment side.
Got it. Great introduction. Honestly speaking, January 2026 has already felt like a long time. Let's not just get into the wider world of crypto, but interesting to hear that you went from institutional to actually studying in depth and writing papers on the potential of Web3 and decentralized technology. A lot of people have a different origin story. I wonder, at the time, as you were working for Morgan Stanley, what was the mood music around crypto at the time? I guess obviously 2016 was still relatively early. And prior to that, do you have any kind of lasting memories from institutional opinions back then compared to now?
A little bit. Like, I remember I tried to bring in some clients, and those clients at the time, kind of the biggest companies, were the miners, that ended up being the first companies in our sector to go public. And so I did actually, and I worked initially in equity capital markets, right, which is essentially, IPOs, equity offerings, on NASDAQ and New York Stock Exchange. And I did try to actually bring in a few clients, and I actually arranged one meeting. But I think there was a lot of hesitancy, from those financial institutions, not without reason, right? Because you have to remember, if you wind back then, even, far more than today, there was tons of regulatory uncertainty, right? So, you can't really blame those institutions, right? They're slow moving, they're conservative. But I think there was interest, but those institutions are going to be hesitant to go out when there's not clear regulatory standing. And so, kind of leading the question, right? The big change since then is obviously that's cleared up a lot, though not completely.
Yeah, absolutely. And I mean, you can see that the pivot now from, crypto is for scammers, crypto is for money laundering, crypto is a bad thing, to, you know what, this digitization of assets, asset tokenization, and to some extent, the idea of crypto assets is a positive for a lot of institutions. And you're seeing a lot of 2025 and 2026 interest being around how do we create 24/7 financial markets? How do we improve liquidity in certain asset classes? How do we make it easier for capital to flow from one place to another? These are all kind of traditional financial engineering topics. These are not new to world. These are not necessarily new asset classes or material innovation, and maybe what you foresaw when you wrote your paper on Ethereum. But like it or not, the institutions are now amongst us. And it's probably been interesting from your perspective to watch from the outside. What we will do next, we'll jump into fifth era. Before we get there, guys, if you have any questions, as said, please do put them in the comment section as we're live. Also, let us know where you are. Where are you working? What projects are you working on? What's your interest in Web3? What are your exciting predictions for 2026 in terms of Web3, blockchain, and crypto? Is it going to be the year of institutions? Do decentralized applications still have a chance? Are there other meaningful uses of decentralized technology that we're concerned about, interested in? Where do we see quantum? Where do we see AI? Lots to discuss broadly. So please remember to put your comments in the comments section. Mitch, let's jump on to fifth era. You gave us a little teaser before, but talk to us about, where did fifth era spin out from? What are your guys' unique advantages or unique selling propositions? And maybe what are some of the projects in your portfolio today?
Yeah, absolutely. So the firm was founded by Matthew Lemerle and Allison Davis, who are longtime technology investors. And essentially, they wanted to set up a firm to invest in innovative technologies. We started with a fund of funds model. So we invest in early stage venture capital firms, that are investing at seed, Series A, very, very early. And so now you fast forward, we've allocated to about 60 funds across 5 fund of funds in blockchain and 1 newly closed fund in AI. So that was really the genesis. And again, that started in their family office about 2014, spun out into a dedicated asset manager in 2019. And the idea there basically being that these very risky, innovative technologies have a high dispersion in return, meaning that, basically a very small number of companies are going to drive the lion's shares of the portfolio returns. And so it's absolutely critical to be in as many unicorns as possible, right? Venture capital is all about getting in those unicorns. And if you're in a generalist venture fund and they make 25 investments, the difference between in 1 and 3 unicorns is the difference between top quartile and not returning capital. So the fund of funds model is quite interesting because it basically allows you to expand your universe, have more diversification. And if you're allocating to top tier funds, theoretically, and I think our returns have proven it out, that you effectively, you do cap your upside ultimately, but you actually create a much higher likely middle outcome. And so we really enjoy the fund of funds for technologies like blockchain, like AI, in getting our first foot in the door, so to speak, with these technology asset classes in the ecosystem in a lot of these companies.
And what does a good return look like for you? Obviously, kind of, if you speak to anybody who spends their time in and around crypto, a good return could be 1,000x, or a good return could be 10%. What do you typically look for? What would good feel like to you guys over a period of time?
Yeah, it's a great question. So I think, top returning quartile in venture capital is kind of 25% plus IRR. And again, you have to basically get excess returns to make up for the illiquidity discount, because you could always just put your money in the S&P 500 if that's going up 7 to 9% a year, but you can sell it any time, right? How do you induce people to come give you capital that's getting tied up for 5, 6, 7, 8, 10 years ultimately? Our fund of funds, we target kind of in the 15 to 25% range. Our first fund has well exceeded that. But this is an investment advice. We're not going to go out there and promise that on a consistent basis. So we've been very successful.
Absolutely. And everything on this show today is not investment advice, albeit you are an investor. So anyone listening in, please always do your own research. Please do spend time looking at multiple sources of information and not just ChatGPT when you invest your own money. Wanted to get that out there early because there is going to be more investment chat. Sorry, Mitch, you can have the mic back.
The interesting thing about crypto and the fund of funds model is, right, this tokenization component, right? That, if you look at our portfolio, about 60% is equity and about 40% is token. So again, a lot of your viewers might know, but in our industry, we can either invest in the equity of a company or often in, protocols, platforms, tokenized businesses that launch a token. And since Sarbanes-Oxley in 2002 in the US, the route to an IPO has taken a really long time. So prior to 2002, you had companies IPOing in 1 to 2 years after forming, right? Basically, after the big Enron scandal, they really tightened the rules around it, not without reason. But one of the unintended consequences of that is that it's much more costly to go public, and it takes a lot longer. So general venture returns have pushed out, which lowers your IRR, right? Because IRR is a time, related metric, right? The earlier you return the capital, the higher the IRR. Tokens have made our sector very interesting from an LP perspective because tokens are launching much more quickly than equity, or at least they have been, really until the last year, I would say. And so that's allowed a lot of venture firms to have crazy high IRRs because the tokens were launching much faster and they were able to do it, outside the US, arguably because of a little bit of regulatory arbitrage, which we could get into. But it definitely made the fund of funds model, very interesting, from an investor perspective. And then the last thing I'll just add, which I didn't get to, is that we have this, very healthy, well-known fund of funds business, blockchain AI. And then really where I spend my time is that we monitor this fund of fund, which now has more than 1,200 companies in the portfolio, 80 unicorns. And as companies mature from, seed, Series A to B, C, D rounds, and ultimately they're going public events, that's really where we lean in and we invest directly onto the cap table. And we can write 8-figure checks and have been very active in secondaries, in rounds, in going public events. And so we really like that balance where the fund of funds for very early investments, you have that diversification, but then as companies mature, we want to get more concentrated, right? But obviously risk goes down and so does potential return typically. So there's always that trade-off.
Appreciate the intro there. And I think this is worth taking a beat on because there are some companies that offer you equity and tokens. There are some companies that will offer you one or the other. Do you go in with a particular view on which is higher risk, higher quality, more attractive, and maybe bonus points at the end? Do you actually think that Web3 companies have got an appropriate handle on valuation for equity versus tokens at this stage? Are we too early?
So in a perfect world, we always want equity and token. And it's very simple because as an investor, you want to have ownership wherever the value accrues. So the kind of market standard I would say right now is a Series Seed, Series A preferred share class, which is an equity investment with a token warrant. So that way, if the management team, the company ever launches a token, you're also going to get that. And a lot of these businesses, it wasn't exactly clear where the value would accrue. And, we still don't know necessarily. Sometimes you have a good idea. Now, that being said, we've done fully tokenized investments. We've done equity only investments. But in a perfect world, I think all things equal, you want equity with a token warrant. So whichever way the value accrues as an investor, you're getting your share of that value.
Makes sense. It's a good steer. And there's plenty of projects that are out there that just have tokens, right? And they say, we're going to launch tokens. We're going to have a foundation. The foundation will get an allocation of those tokens, and we will allocate those around for fundraising. We'll sell those at some sort of discount to a VC somewhere, hopefully not too low. And we'll pray that the VC doesn't dump and affect our liquidity in a very short period of time. This is the Web3 circa 3 years ago story.
Yeah. No, there's a lot of risk in that model as well, because you have all these laws surrounding equity, which are good things generally for investor protections, right? So with tokens, you have to be extremely careful. And during the kind of craze of 2020, 2021, you had a lot of, anonymous teams doing token offerings, not a lot of disclosure, maybe no lockups, things like this. The market has generally moved away from that. So even if there's no law around a token offering, generally, legitimate VCs are no longer going to back those types of things because the air has kind of come out of the market. But in general now, I would say, even if it's a tokenized, deal, and again, one I could talk about is we invested in Karate Combat. This is public. It's a fully tokenized sports league. There is no equity. The token holders own the company, which runs a real life action karate league. Really cool idea. One of those, far out, kind of on the curve crypto ideas. Not our core thesis. Our core thesis tends to be infrastructure and payments, things like this. But we have dabbled in these things. We invested in Lens protocol, again, tokenized version of Twitter. So we're interested in these things. But you always have to, it takes a ton of trust, right? If you're investing into a token based out of the Seychelles with a, foundation based in Singapore, right? It's sort of a completely different animal that you need to be really careful, around when you're doing your diligence versus your standard, this is a Delaware corporate structure based in the US, very clear recourse if you're defrauded, things like that.
That's really helpful. And not many people listening in get to go through this level of investment due diligence or go through that sort of quality. It's like, oh, I kind of like the project. I kind of like what they're doing. I know the founder. I'll pick up some tokens and see what goes on. When you're writing an 8-figure check, significantly different story. I mean, there may be some people out there who are throwing around coins with that.
But to be fair on that point, right? I think the market can create euphoria, and even world-class investors in equity can lower those hurdles, right? And so obviously the famous case is FTX for those of us in the industry, but I think that there's a lot of really good lessons, right? Where FTX famously, multi-billion-dollar valuation, raising hundreds of millions from some very well-known firms, much more prestigious than our firm. They didn't have a CFO, right? So things like this, where you kind of head scratcher, but you have to put yourself, again, when the market is euphoric and all of the leverage moves towards the companies. And I remember this, you're getting 1-2 days to make a decision on a fully oversubscribed round. Corners are still cut on the equity side as well. So it's not just a token problem, but you generally have more protections on the equity. And then, coming back to your last question, which I ignored, I just realized on valuation, it's sort of anybody's guess right now. I think that there is a very strong case that the fundamental value of tokens will win out in the end. And what I mean by that specifically is that tokens that actually drive revenue at the protocol level, and thereby can flow that to token holders somehow, either through direct dividends, more likely through burns, aka buybacks. And I think you've seen that, right, with the fee switch at Uniswap, and even the burn mechanism with Ethereum. And that, I think, is the way, because there are a lot of protocols that are making, tens of millions, hundreds of millions, Hyperliquid, Sky. So you definitely have, a fundamental case. The reality is that case is still not expressing itself in token valuations, right? So there still is some level of, I don't know what you want to call it, euphoria, meme coinness, even really good projects. You could argue Ethereum, Solana trade far above what their, earnings multiple would be in a traditional setting. So I would say it's anybody's guess still, but that I do believe, and I think our firm believes, in the long run, real projects that people actually use, where people are actually putting money in, and that's accruing as fees, will win out. But the reality is that that's not where we are today.
Yeah, I think earnings is also still a slightly foreign concept for very many decentralized ecosystems at this point in time, let alone multiples of earnings. I saw a good chart the other day with kind of the average fees generated by across different blockchains. And the reality is that the fees are not comparable to anything that you would consider for the amount of revenue you need to run a business. And so either we have to focus more carefully on the revenue model, or it will continue to be speculation based, which I don't think anybody wants to see. I also enjoyed the part there where he said, well, we've got 1 or 2 days to make a decision. It's nice to see that there's still FOMO investing. I will call this a slightly higher grade of FOMO investing than most, but that when an opportunity presents itself and there's a short time window, you still get that kind of jittery feeling in the stomach, is like, oh, I don't want to miss out on this. I think it could be good, but we've got so little time to do our diligence. That happens in every walk of life, but also in the investor tables. So thank you for sharing that anecdote. That's reassuring to hear.
Yeah, one little point is, specifically in venture investing, I think you do have to kind of change your mentality a little bit, in that it's not about not doing bad investments, if that makes sense. It goes back to what I said. You have to be in the great performing investments. So it's actually completely fine if 60% of your investments go to zero. Now, you want to try to minimize that number, but at the end of the day, the way that a portfolio is set up with a really high dispersion of return and very high risk is that you have to go for those home runs, because those home runs are what's going to return the fund. So if you need to be far enough out on the risk curve that you are having some investments that return high enough to compensate for that risk. And that almost necessitates that you're going to make a few investments that 2, 3, 5 years later, you look back and you go, oof, what were we thinking? But at the time, right, it's very hard to see that. And so I think that, to give a little bit of sympathy to, investments that I look back, in the industry, you look at some of the revenue multiples paid in 2020 and 2021. I mean, you're talking about 100 times, 200 times revenue, things that are not happening today. They are happening in AI, but not in Web3 and crypto. What were people thinking? But again, it doesn't necessarily matter for your portfolio return if you have a few zeros, as long as you're getting in those fund returners.
I think hopefully that's going to make a few people out there listening a little bit more confident or a little bit more relaxed about their own portfolios. Maybe not. I don't know if 60%
by
of
the way,
mine
is
have gone to zero, but
angel investing, for your listeners, angel investing is almost always a terrible idea, because unless you can really start allocating to 20, 30, 40 high quality investments, your expected value is going to be actually very bad, right? And even friends of mine in the industry, other partners at venture firms, as angel investors, it tends to not actually pan out typically, because the thing about venture is that portfolio approach, that's what creates that expected return that's positive.
That's a really helpful build. And vibe investing probably has never necessarily been a return, unless somebody has a really, really good sense or unfair advantage in the industry. I'll take that. So if you're looking for LPs, angels, head this way. Let's get into investment thesis for 2026. So obviously you've had some good, some bad investments over the period of time. 2025 was probably not the year that a lot of people expected in terms of maybe market cap growth of Web3 or Web3 organizations. I think we probably had unfair expectations of how far and how quickly the Trump presidency could move around unlocking the US market, particularly around digital assets, crypto, and general progress from institutions and larger investors. We had a couple of liquidity events that probably didn't help either. What are you looking at for 2026? If you're allocating capital this year, and again, this is not financial advice, just some friendly guidance from Mitch. What are you looking at for 2026?
Yeah. I'll just answer the question very specifically and directly. We're very excited about mature businesses, more mature, that are what I would call pre-IPO or on their way to public markets. And I think if you look back, right, during the Biden era, we had this, basically the door was shut by the SEC and the Biden administration for accessing the public markets. And so because of that, our industry really traded at, a negative premium, right? And so we went out last year, and I think we made a bunch of very well-timed investments into private companies that really the public markets hadn't woken up to, but how valuable they were going to be. And that all changed in 2025 with the Circle IPO. And Circle kind of surprised everybody, and again, being very specific, we and a lot of firms were shown Circle secondaries in the kind of $2 to $3 billion valuation range. And after the IPO, it traded up above 30. And that kind of was a switch, almost like the firing gun of a race for great businesses in crypto, of which there are many, that the public markets is ready for them, specifically, and because there is such a lack of public market companies in our sector. They're really the only, well-known operating company until Circle's IPO was Coinbase, right? You had a bunch of miners, things like that. The other thing that happened last year was this whole DAT craze, right? Which I'm sure you've covered before, but essentially for your viewers is an equity wrapper around a token. So think MicroStrategy, you're buying equity, that equity holds tokens. So really the most interesting thing in tokens in 25 was also in equity. So at our firm, we kind of call it the year that equity came back. And I alluded to at the beginning that for a long time, the exciting thing about crypto investing was actually the tokens. And that kind of changed last year. And so for 26, I think that story just continues. And so we're really excited about a lot of very good businesses that are going to go to the public markets. There's probably 10 to 15 that could easily go into the public markets. We're very excited about the backdrop in general. Again, if you go back just 1 year, or maybe 1 year and a month, the regulatory situation was completely different. The SEC was suing everybody. The CFTC was not playing a huge role. We had no legislation, no rulemaking. And so if you fast forward to right now, right, SEC's removed all of its lawsuits, CFTC's removed its lawsuits, accounting bulletin SAB 121, which prevented financial institutions from coming in industry, that's been repealed. We have the passage of the Genius Act. We have basically an entire shift where before last year, the whole thinking around the industry was we need to leave the US, to now the US is certainly the center of gravity in the industry again. And so the backdrop, I would say, has never been stronger, just from a fundamentals view, right? Financial institutions coming in, regulatory certainty, and again, we're not completely there, which we can talk about, and a clear demand from public markets for crypto companies, for their equity, basically. And again, we saw eToro, Circle, a bunch of other IPOs, Gemini, others I'm not remembering here right now, but that I think is the big story, is that we think there'll be this continued push to equity markets in 26.
Got you. And as the sort of organization that's going into that, are you thinking about exchanges, infrastructure providers, software providers, as opposed to protocols? Because I think everybody's kind of traditional reference for investing in crypto will be, I'm going to buy a protocol token, or worse, I'm going to buy an NFT. But I'm going to buy the token of a protocol on which things exist, and that's where we go. I think we're unlikely to see protocols IPO. Brad Garlinghouse came out last year and said, Ripple will never IPO, and more recently had said, I am unsure, or I do not believe that Ripple will IPO anytime soon. A sort of slight softening of the language, as if to suggest that maybe. But broadly speaking, protocols IPOing feels unrealistic. What are the categories of organizations then that fit in your model?
Yeah, no, I think that's right. I think, again, because most of the protocols don't make enough money to really be interesting, and they kind of backdoor IPO through this DAT phenomenon, right? And, so I just, I think Ripple, I don't understand why would Ripple want to IPO? They already have a huge balance sheet that's liquid, that they can go out and make acquisitions with. Sure, eventually the equity side of that business, they're going to want to monetize. But the equity essentially owns most of the Ripple token. So they have a huge balance sheet because of that. I think you're looking at businesses that are exchanges. So obviously Kraken comes to mind, where we're investors, full disclosure. There's also lesser known exchanges, but equally as impressive, such as Uphold, really impressive exchange. We're also investors there. You have the first tokenization platform going public, which is Securitize, which has announced it's going public via SPAC with Cantor Equity Partners too. Again, full disclosure, we're investors there. And then there's loads of companies where we're not investors that are also great companies. So BitGo, which is a custodian, should price its IPO. You could see a Fireblocks go public. You could see Bitwise, an asset manager, go public. So I think, sort of infrastructure type companies that are in payments, custody, exchange, that are generating real revenue, and in pretty much all of those cases that I mentioned, positive cash flow, EBITDA, at a certain scale, will look to tap the public markets, I believe.
I think so. And that, honestly speaking, that makes sense to me as to where we are right now. We definitely don't need more protocols at this point in time. I don't think we need more block space. I think we have some challenges around the configuration of some protocols and whether those are fit for financial markets, capital markets, and traditional finance in general. Public Ethereum with encrypted data on chain and correlation of metadata is not something the financial markets will love. At the same time, trying to do everything in TradFi on Zcash or Monero or Dash is also probably not the way that it's going to go either. So there are some gaps in, I guess, functionality to serve the financial services industry, but that can be done a number of different ways. In the meantime, tokenization, wallets, staking providers, custody providers, anybody who can provide services to the financial industry that they won't self-serve, can't self-serve, or choose to de-risk and outsource. Makes sense, right?
Yeah.
If we believe that the floodgates are open, that's what's going to be needed next.
Yeah, and it kind of ties to what I was saying about the regulatory certainty, right? Because the reality is that global financial institutions now can embrace our industry, and that will drive a lot of flows and a lot of revenue and a lot of fees, right? And we're seeing it with JP Morgan and Visa. Morgan Stanley just announced it's launching ETFs in the industry. The BlackRock ETFs are probably its most successful product they've ever launched, right? So I think, at the end of the day, I think a lot of us got into this sector for ideological reasons, of which I would consider myself one, right? Like, I truly do believe the technology is important, standing up against, centralized intermediaries, whether it's governments or financial institutions. But at the same time, I'm also a realist. And, I do believe that to have broad acceptance, we're going to need some relationship with the financial sector and with governments, right? Or at least that will massively speed it up. Sorry, go ahead.
Yeah, I think the professionalization of Web3 has been long called for, albeit you don't want to do that at the expense of innovation. You don't want to hinder the ability for us to create new and innovative designs for organizations, DAOs, new and innovative ways of engaging individuals or transferring value globally. That yes, you can do through TradFi if you want to buy your tokenized stocks through TradFi. If you want to invest in something in a decentralized way or hold self-custody Bitcoin, you don't need them. So we don't want to lose the ability to have the kind of original value propositions of Web3, but extra capital, extra liquidity, proving that our technology can work at scale, even teasing out some of the challenges like how do we do dividends for tokenized equities?
Yeah.
Is just something that for most projects we haven't thought about yet. We've done airdrops, but are we airdropping dividends now? How does that work? So I don't think it's necessarily
there's been a lot of promise in this, though. I just want to add is that where financial institutions have come in, I think it's still stayed close to the original value. So like specifically, we're big investors in Securitize. We think it's a fantastic company. One of their big investors is also BlackRock. They've obviously launched the largest tokenized fund in crypto is BlackRock's money market on top of Securitize. First place they launched on Ethereum, right? So I think things like that are really, really interesting in that you have this big financial institution, the world's biggest financial manager, launching a fund on a open source, permissionless blockchain, right? And now obviously there's some guardrails around it because you have to comply with US regulations because the money market is a security, et cetera, et cetera. But I think it's really encouraging, right? Because, just because it's crypto doesn't mean you can't comply with laws. That's not realistic. So I think there's a lot of really interesting things to that. Another kind of point to that is, although the banks have been lobbying heavily in Washington and with the Genius Act and now the Clarity Bill or the market structure bill that's going through Congress, the stablecoin legislation that passed in the summer, created rules of the road for stablecoins on permissionless blockchains, right? So we effectively have stablecoins that you can send around, without checks. Obviously, if you break any OFAC or sanction rules, Circle of Tether will work with the authorities. But, aside from that, there's no restriction on permissionless blockchains passing around synthetic dollars, aka stablecoins. So I think this kind of collaboration, it remains to be seen what the ultimate end state is. But I'm cautiously optimistic that we're going to have financial institutions dabbling in open source, permissionless, open technology, which I think is incredibly important.
Fully agree. And to draw one final analogy before we move on, the tokenization of everything started with CryptoKitties or CryptoPunks, or take your pick of which other slightly vulgar NFT project came later. This was just proving that we could tokenize something of theoretical value. In financial services or TradFi, we're probably going to see the same thing. They're going to start with what's familiar. They're going to start with what's liquid. They're going to figure out what works and doesn't work. And then hopefully you see an expansion of innovation that comes from there. So it doesn't have to be a bad thing. Compliance and protecting the consumer or the investor is not a bad thing either. At the same time, the self-custody option is always there for you. So let's see how it plays out. At least we've got a slightly better macro environment behind us for launching the technology and seeing it used at scale. I want to move on to the next question, which is what makes a successful investment? So obviously you've made a number of investments over the years. You have a current ongoing portfolio that you kind of can choose what you do with on behalf of your investors or on behalf of what your mandate is. How do you judge what is good or bad? I did have a banner here that said what makes a successful investment, but the StreamYard stream apparently seems to ban that. In the same way as anything that when I had equity and tokens up, it shut that one down as well. So if you saw the banner, there it was. It's gone again. StreamYard messing with us. See, censorship is real. This is why we need Web3.
And so maybe just to double click, not investment advice. This is just our experience. So look, again, in our model, when we're looking to make those investments, the first screen we use at that mid and late stage is, are they already backed by a top early stage fund, right? So, for our purposes, we're not going out and boiling the ocean. We are looking for people who are able to secure elite investors at the early stage, ideally through one of our fund of funds, because that's just an initial filter, right? And it allows us to quickly get to the top talent. After that, top team, right? It's a people business. You have to have people you can trust that are very capable. Massive market. So I think, again, in venture, it's all about very large outcomes. So you can have a great team, great product, but if the market's not big, it's not going to be a great investment. So you have to have a great team and a massive market they're going after.
Or worse, the market doesn't value the potential of what you've created, which is almost a kind of perennial Web3 challenge. Overinflated expectations in some cases, and underinflated expectations of the stuff that's actually useful.
Well, look, I think it's okay to take an asymmetric view. And often in venture, a lot of the times the best investments are asymmetric. So you might think the market is going to be large, but nobody thinks that yet. And there's a few cases in which we've done that and we were right. And, a few cases, where you invested heavily into, NFTs and the market hasn't come back. But it remains to be seen if maybe it will later. So I think, again, you're allowed to go out and make asymmetric bets. When we're investing at more mature later stages, which is, again, where I spend most of my time, typically we want to see product market fit as well, or a clear path to product market fit. So again, going back to teams, right? I think one thing we like to see in teams is rapid ability to pivot and try lots of different things. And when we talk about some of the companies, again, I think a lot of the best founders, right, they're constantly getting feedback from their end customer. They know their customer so well because they just have to try a lot of different things, because the reality is you might not know exactly, right? You're trying to create something new. At our stage, again, ideally revenues that are growing. Almost always we want to have that. Again, in rare cases, we might go pre-revenue, but I think generally as you get to more mature businesses, it's hard to justify pre-revenue businesses, in a rational market environment when you're talking about higher valuations in later stages. And then I think really important as well that a lot of people overlook is line of sight to an exit. How are you going to get your money back? And this is really important in token investing, where things like liquidity and how are you going to custody and are there trading venues, right? You got to think through, can you actually sell? How will you sell? Who's the buyer? And then just the same on the equity side, right? Is there a natural universe for M&A, which is much more likely than an IPO? Could this business ever IPO? Why couldn't it IPO? Which jurisdiction is it in? All of these different things come into effect. But you have to think, okay, I'm buying at X. Even if I'm right about all the things, if I can never sell, well, that's very difficult as well. So kind of from the top, it's top team, massive market, product market fit or close to it, revenues, real revenues, generating cash, line of sight to an exit. Those are generally the principles we start from. But the reality is investing is that there's no science. And I always say it's more art than science.
I mean, at least there are some guardrails, right? Some of it may come down to instinct, or some of it may come down to right place, right time. And again, like you said before, you're placing a large number of bets. So it's not that you have to get it 100% or perfectly right, but you see the conditions. And I wouldn't argue with any of those. I wonder, maybe you're not allowed to have favorites, but of the investments you didn't make, rather than saying, hey, there's an investment I turned down, I wish I hadn't. That's a less fun story for me than, was there an investment you deliberately didn't make on those criteria and were found to be proven kind of, I don't want to say right, but grateful that you didn't, or that, that was capital you didn't allocate and as a result, you protected your investors, or you just felt generally you weren't supporting something that didn't deserve the support?
Yeah, I mean,
You don't
I
have
don't
to
want to
name
be,
names, but it would be
yeah,
helpful if you do.
I don't want to be too mean, because I think, it's a small industry and everything. And again, I think investing in venture is not about not getting things wrong. And if you have that mindset, you're not going to be taking enough risk to get in the really good deals. So you can't be afraid of making mistakes, is another way to put it. But I do think we did a very good job, say for one or two or three kind of investments out of maybe 40 in the last 5 years, of not chasing crazy sky high valuations in the market hype cycle. So if you look at our investments, pretty much all of them are defensively sound from a valuation perspective. And to be more specific, again, I think we had a lot of opportunity to invest in NFT related platforms right in that craze. And we didn't. And I actually really believe in NFT technology. And I think NFTs will ultimately come back in some form. But I think that we did a good job of being a bit more cautious when the craze was going up. And again, there's some very famous names that did very large rounds, selling hundreds of millions of secondary for the founding teams as well. That now just look, those investments look absolutely crazy.
Nike's investment in Artifact, for
Yeah,
example, which I
I'll
think
let
they're
you
now
name
divesting.
names. I'll let you do the names.
And again, that's not to say that I didn't love the products. The team were incredibly talented. The way that they captured the imagination at the time was phenomenal. But maybe the valuation was greater, or the potential that Nike saw in that particular project was greater than the reality turned out to be. And that's okay, right? If you're Nike, you can afford to make that sort of bet and for it not to work out for you. If you are a different size of organization, you put a lot of your capital into it, maybe a different story. And on the NFT thing, I mean, NFT is tokenization, right? So what we demonstrated in the NFTs is the tokenization of art, or the tokenization of ownership rights of things. The meta trend of 2026, from what I can read in multiple sources, is tokenization, which is such a broad term as to be almost useless. But if there were no NFTs, you wouldn't have tokenization. So here we go again.
Yeah, it's one of the many experiments with blockchain technology. And again, I think it's really interesting. A lot of really cool experiments were done. A lot of NFTs on the collectible side still are very valuable. Just the market became incredibly bifurcated. So if you have a CryptoPunk, or you have, Pudgy Penguin, or you have, whatever top project, they still are pretty valuable when you think about it from first principles of this essentially community you're selling. But, much like the regular art world, you kind of have this very small, very valuable top, and then everything else kind of fell out from the bottom. But I still think that there's a lot of really interesting ideas to be done there. And but again, I think you can be right in a thesis and get your timing wrong, and it's as good as being wrong, basically. And so the timing wasn't there. And so I think we are happy. Not to say we made probably one very bad investment at that point, but we had the opportunity to make many bad investments, and luckily didn't.
I think it's quite a nice way of looking at it. Let's fast forward to the rest of the year. We're going to look at predictions. Hopefully StreamYard doesn't ban us for this one, because it's not a financial term. Maybe it is. Let's see. But I said everybody under the sun is making broad, sweeping, and oftentimes not very specific predictions for what they think is going to be important areas of growth or important areas of progress in 26. I'm not going to give you the metric. I think I'd love to hear your view on what do you want to see, or what are the three things that you'd like to see this year, and what's the metric that you would use to evaluate success?
Yeah. So, I mean, there's a lot of different things you could say. I would start with regulation, because I think that that's proven really critical just for creating a stable base, right? And again, if you wind back and you say, what were things holding back the sector? Well, part of it is, if I don't know for sure that this is a legal business, or that I'm going to get sued, or whatever you want to call it, it's very difficult for real capital to come in, to bring founders in, to bring developers in. And so I think that the sort of sentiment and reality has shifted wildly. But one of my predictions for 26 is that everything will start to focus very critically on this market structure bill that's making its way through the Senate. It's already passed the House. I think President Trump actually mentioned it an hour ago in his Davos speech. And so I think that law becoming law, which is that bill becoming law, will ignite a huge amount of interest, euphoria, capital building in the industry. And so I think that for me is kind of prediction one, is that regulation will continue to be the most important thing in the industry, for broader sentiment. Right to number two. So number two, I would say, stable coins
everywhere.
No, I think I want to say is that you get massive adoption from financial institutions in stable coins. And I think it's kind of cheating prediction because it's almost so obvious to people in the industry. But again, I keep meeting non-crypto people and they don't even know what stable coins are. And so I think, the fact that it's become a $300 billion industry without, regular people on the street maybe even knowing what it is absolutely, wild. But I think, again, the Genius Act just passed in August, right? So now we're only 6 months into knowing for sure that stablecoins are legal in the United States. And the MiCA rules in Europe just went into effect last year as well. So now
you're not the most stablecoin friendly all of the time, which is unfortunate, but
yeah, but I think, and there, obviously this is debate. You can say, we don't like this. And even in the Genius Act, okay, what about, passing on, interest and, are the, collateral obligations, right? I mean, you can always nitpick different things, but just creating the framework that says, okay, I'm JP Morgan, I'm Visa, I'm MasterCard, I'm PayPal. I now know that I can invest in this industry because businesses like that, they don't invest for 1 year. These are 5-10 year decisions. And so I think that you're really going to start seeing, very large financial institutions lean very heavily into stable coins. And that could come out as launching their own stable coin or buying stable coin businesses. Or, like in the case of Visa, they've announced they want to pay vendors using stable coins, right? So it's going to create this just massive change to how the financial system works. And you can already see that going back to the point before on the regulation of the US banks are now lobbying super aggressively because stable coins are a very large threat to some of their businesses, net interest income, payments, things like this, not to the entire bank's business, but, there are ways in which stable coins could, allow you to make payments outside of the banks or even hold deposits outside of the banks. So I think it's going to be an absolutely enormous theme for this year because, Genius Act, which is the stablecoin bill, just passed at the end of last year. And so now sort of we have a very strong footing for stablecoins to continue to come into the US financial system.
And to look further afield, China and its digital yen has issued that it will be yield bearing, will be interest bearing. So you will have yield on stablecoins in China, which puts some interesting pressure on the rest of the world in terms of most of the regulation pointing towards no yield on stablecoins. Well, if one of the largest markets in the world is offering that, that's already a competitive shot across the bow. So let's see how that one develops. On to point three.
Yeah, so now I'll make a Bitcoin one for the fans, but I think that Bitcoin will continue to mature as an asset class. And what I mean specifically, and I think we've already seen this, it is going to be less and less viewed as purely a risk on sentiment bet and is trading as a mature gold-like asset class, right? And I think we've already seen that. Again, in the industry, we get so caught up in the day-to-day. We're like, oh my God, Bitcoin's fallen, everything, are we done? Bitcoin's been trading between 90 and 100K US. I mean, again, if you just think back to, for those of us who've been in the industry, it's sort of like, we're great. Everything's doing really, really well. Right. And those high prices without this crazy retail fueled euphoria where people are asking you on the street, have you heard about Bitcoin like it was in 2020 and things like this. Right. So Bitcoin is already kind of at this incredibly high level, and no one's really paying attention to it. No one's talking about it. And I think that that's only going to continue as this asset class becomes more and more mature. And as more people are interested in it, the volatility should compress. So I think that that's one of my predictions is sort of a continuation, which is I think Bitcoin is going to trade more maturely, and will be less sort of exactly coupled to, let's say, Nvidia earnings, or sort of these very risk on news events that in the past could cause it to swing 20% up or down. Those were exciting days, but I think that those days are going to continue to dwindle.
Wouldn't that be nice? Bonus round question. How do you feel about tokenized gold or tokenized other commodities at this point in time? You're seeing them starting to appear. Frankly, from my perspective, since about 2017, I would get unsolicited emails from people who said they had a gold mine in insert name of lesser known developing nation here and wanted to tokenize it to improve liquidity. Do you see that that is a competitor to gold, to Bitcoin? Do you see that that's a meaningful addition to the Web3 ecosystem, or is that just basically tokenized equities or tokenized commodities that allows gold to trade more easily or more broadly?
Yeah, I really like tokenized gold. I think it's a really interesting product to offer people. I don't think it's a direct competitor with Bitcoin, right? I think Bitcoin is sort of digital gold, right? So we're talking about digital scarcity in a world where there's going to be no scarcity because of AI, right? So the digital scarcity is going to be scarce, which might sound obvious, but we're going to be in a world, right, where content is abundant. Everything's going to be abundant that's digital. But Bitcoin is one tiny area of the internet where we have this digital scarcity. So that's incredibly valuable. It sort of is in the same area as gold, but gold is very different, right? Gold sits in the real world, and you have to have someone custody it, and you have to pay for it, and someone has to watch it, and someone could come steal it. And if I want to sell it, well, you got to ship it somewhere, right? So it's sort of different, which can be good and bad. So I think tokenization could open up the opportunity for more people to buy gold. And there's already sort of gold wrappers, right? So you have gold ETFs. It's not that different than tokenized gold. So I do like tokenized gold, but I don't think that the tokenization of gold necessarily means people will switch from that to Bitcoin. I just think you'll have a allocation in your portfolio to both.
And if it's tokenized in a way that's appropriate, then that allows you to use it as collateral for various different other use cases in DeFi or wherever you find yourself. I'm interested in seeing how many digital gold products enter the market over the next little while, how many digital silver products enter the market over the next little while. I think the space of tokenized things is going to get a little busy. And I wonder, how do we cut through that with decent user experience that isn't necessarily through an investment manager? I hope we can solve that problem.
Yeah, so we worked very closely with Securitize, which is our largest tokenization play. And as I mentioned, they're going public. BlackRock, they've tried everything under the sun. We've met with lots of projects tokenizing all sorts of things: real estate, gold, copper. I visited mines, not mines, vaults to look at the gold. So I've been down this path. I think the key lesson from tokenization, which Carlos Domingo, CEO of Securitize, would always say, is that just tokenizing something does not create a market, right? So you have to have real demand and distribution and customers who want the thing. Then tokenization unlocks tons of values because it's just easier to move around and all the back end is super easy. I always say that blockchain is a really boring technology. It's a financial infrastructure technology. There are very cool, crazy ideas. Again, we've invested in a lot of them, but in general, it's sort of like the tubes of the financial system is being automated, right? And so just because you automate the tubes doesn't mean someone's going to want your tokenized real estate offering, right? You have to have that real distribution built. So in that regard, again, companies like Uphold, many of the exchanges, right, offering tokenized equities, gold, etc. That's really interesting because they already have distribution channels. You'll probably see the same thing, if not already, on Revolut and Robinhood. So in general, very, very pro tokenization, but just by virtue of tokenizing something does not create an immediate market or demand for that item.
Indeed. And like you said, you're going to see venues that may have their own proprietary gold tokenized products where they have got some sort of guarantee of the original gold somewhere in the back. The risk is that we create this ridiculous bubble of DATs and tokenized things, and there's more value in the tokenization of the things than there is the actual things themselves. And you end up with a big short inflation of tokenized things and value. But let's hope we don't get there again. The financial markets have learned their lessons from last time, right? Or at least we hope so. No comment.
Yeah, no comment, exactly.
Mitch, it's been an absolute pleasure having you on the show. I know you got a hard stop, so thank you so much for joining us today. Appreciate all of your insights and wisdom. As we said throughout the show, this is not financial advice. This is Mitch giving us an insight into the world of VCs and investments. So thank you so much for taking the time today, and go have fun out there.
Yeah, thanks so much. It was a lot of fun coming on to talk, and really appreciate what you're doing. And for any of your viewers, if you're interested in learning more, you can always go to our website, fifthera.com. And if you want to get in contact with us, there's ways to do so there. So thanks very much.
All right. Have a great day, Mitch. See you soon.